What is up, everybody? This is Books of the Stock Market. I hope everyone is doing well. This is the Sunday report where I cover the top articles from Monday through Friday. At the end of each article, I'll be giving my thoughts on how the article could impact or has impacted the financial markets. Without further ado, let's get into this week's Sunday report. Continuing from last Saturday to this Monday, Bitcoin wiped out $200 billion off its market cap. This caused other cryptocurrencies to tank as well. Many analysts attribute this to profit-taking as price increased from around $20,000 to $40,000 in a matter of days. However, many agree that this is not a good look for Bitcoin. For an asset to be called Gold 2.0, it is still too volatile for many institutions. In the end of the 3-day period, the price of Bitcoin was down around 28%, while the price of Ethereum took an even more drastic hit of a 32.84% decrease in price. After watching the price action of Bitcoin over the past month, I believe that a pullback was necessary as Bitcoin was showing parabolic growth. Furthermore, in the last bull cycle in 2017, there were drops as big as 40.66%, so a pullback of this magnitude shouldn't be so surprising. Twitter was down over 6% at Monday's close. This move downwards was caused by the company banning President Donald Trump from its platform due to Trump breaking the guidelines of the social media company. This naturally drew a lot of attention as it brought up the topic if private companies should be allowed to limit free speech. Trump was also banned by Facebook, and Amazon dropped popular Republican social media platform Parler from its web hosting services. As this video is not for going over the politics of free speech, I'll just give my interpretation of how this could affect the financial markets. I believe that after the smoke has cleared, the action that big tech took will be carefully analyzed by the government. For instance, this could lead to the breakup of big tech if Congress believes that they acted out of line. Therefore, it should always be in the back of everybody's mind that big tech could be regulated in the future. On Tuesday, the US dollar tanked as gold rose. Analysts believe that the dollar tanked due to Biden saying that he's planning to deliver a $1 trillion stimulus package. As the Democrats have both the House and the Senate, there's not much to block his plan. With news of additional and bigger stimulus package, stocks and commodities rose while the dollar tanked. This price action writes itself out since injection of money is inflationary while a popular hedge against inflation is buying gold. There is not much to say about this story other than that if you're not invested in the financial markets due to the worries of the bubble popping, then you're incorrectly positioned. I understand that evaluations are out of this world, but with governments out in the world injecting a lot of money into the economy, the incorrect trade for now is to be waiting on the sideline trying to time the market top. Also on Tuesday, oil hit around $57 a barrel, which is the 11-month high. The rise in oil was due to Saudi Arabia cutting their oil production last week. Saudi Arabia cut their oil supply last week due to the coronavirus resurfacing again as shown in London's new coronavirus strain. In last week's OPEC meeting, most countries decided to leave their oil output and change or increase it very slightly. However, Saudi Arabia decided to cut oil production. Another reason for the increase in price is due to governments all around the world injecting money into the economy. The injection of money causes money to flow into commodities like oil. I believe that at this point, the only thing that is holding oil down is the coronavirus travel restrictions. Other than that, oil prices rising generally causes economic growth to decrease as oil affects most, if not all, parts of the supply chain. This is not a positive look as the current state of the economy is not so good. But with inflation happening due to the stimulus packages and the recent supply cut in oil, the only place for oil to go is up. On Wednesday, additional news about the Biden administration stimulus package was presented. Brian Deese, who is the head of the National Economic Council in the new administration, said that Biden's stimulus plan will be divided into two parts. The first half of the stimulus package that is planned to be unveiled on Thursday focuses on the short-term problems. This stimulus package would include the $2,000 stimulus checks. The second half of the stimulus package will focus on programs that will aid in longer-term recovery. Although we already knew that some sort of stimulus was coming on Thursday, now we can confirm that the stimulus package will be pretty significant. This should cause commodities and the stock market to rise as more government spending is confirmed. I personally am positioned in Bitcoin after its 28% drop, so hopefully inflation does its magic. Getting away from looking at the overall economy, let's look at a specific stock. On Wednesday, it was leaked that Intel CEO Bob Swan will be leaving Intel and VMware CEO Pat Gelsinger will be replacing him. This caused Intel stock to rise 7.5% while VMware dropped 6.5%. Some analysts believe that this was caused by Third Point, which is an activist hedge fund that took stake in Intel earlier this year. Personally, I believe that this is a good buying opportunity, as Intel currently has a PE ratio of 11.42, which is super low when compared to other tech stocks. Furthermore, they replaced the CEO with a person who has an engineering background. This was pretty significant as Intel was losing market cap due to inferior products when compared to their competitors, and an engineer at top will hopefully lead to more innovation at Intel. Some analysts believe that this was caused by Third Point, which is an activist hedge fund that took stake in Intel earlier this year. On Thursday morning, the initial jobless claims came out and we saw an increase from 181,000 to 965,000 people. This increase was very surprising to many analysts as the initial estimates for jobless claims was around 789,000. From these numbers, analysts believe that the third wave of coronavirus that happened during Thanksgiving break has really taken a toll on jobs. Stocks, on the other hand, still open green even with bad numbers. Personally, I thought this wasn't really unusual as every time bad job numbers came out, it really didn't affect the markets. I believe this correlation is due to the Fed keeping the markets up and, well, to be honest, the majority of the stock market is owned by the rich who got richer during the pandemic. Bad job numbers usually affect only people who don't have any investments in the stock market. However, whatever the reason may be, I believe that the financial markets rising as the state of the economy gets worse is a worrying sign. Additionally, on Thursday, Jerome Powell said that he will be keeping interest rates low for the foreseeable future. He made this statement because sometime last week there were people saying that the Fed will press the brakes and raise rates. He further added that he would only raise rates when inflation would be a problem. This article is pretty significant because I don't know who exactly started this rumor, but last week there were articles coming out saying that the Fed might not keep interest rates low. However, this Thursday interview seems to contradict all those rumors last week. Therefore, once again, the correct play for now is to be invested in the stock market as the Fed will be supporting its rise upwards. To finish Thursday off, Biden released his stimulus plan of $1.9 trillion. The main points from his stimulus plan include $1,400 stimulus checks, increasing federal minimum wage to $15 per hour, and extending unemployment benefits and eviction moratoriums until the end of September. This plan is considered to be first of two bills that will help combat the coronavirus. The second bill is said to be coming in February. The markets did not initially react very well as they fell when Biden's stimulus plan was leaked. Currently, futures are trading flat, so only time will tell. Personally, I felt this as huge government spending. I mean, look at the M1 money supply graph. As you can see, the M1 money supply went parabolic the past year. Therefore, even if markets currently look shaky, the correct play seems to be hold as little cash as possible. JP Morgan Chase, Citigroup, and Wells Fargo released earnings before market opened on Friday. Major banks fell after they rallied for the majority of the week. Analysts believe this happened due to three reasons. The first reason is that investors may want to take off profits after rallying for a month. The second reason is that it is obvious that coronavirus cases are coming back as countries like China, France, and Germany are seeing an increase in cases. The final reason is that Jerome Powell said that he will be keeping interest rates low for an extended period of time, which is not good for the banks as a core component of their business is lending money. I thought this article was pretty significant as one of the early indicators of a drop in the financial markets is banks retracting. Clearly, the market is very shaky and it should be interesting how this all plays out. On Friday, the dollar was at its highest since December 21st. This caused stocks and commodities to fall. The dollar started to rise as countries such as France and Germany introduced lockdowns. This and the slow vaccine rollout caused markets to lose confidence. Also, due to the coronavirus, oil retracted after making highs this week. Yields also went lower as U.S. retail sales missed. Another reason for weakness is Biden's stimulus plan. It seems to be that the markets were pricing in a lot more stimulus than what was delivered. Overall, I thought this was a good article to wrap up the week as it showed that the dollar was slightly up, yields went lower, and stocks and commodities wavered. So what are my thoughts on this week? The week started off pretty strong but ended very shaky. I believe the weakness was caused by markets pricing in more stimulus, the influx of coronavirus cases, and additional lockdowns. However, even with all this uncertainty ahead, I still believe that my bullish sentiment is correct as there's more stimulus coming and there are not many places to spend or put your money. Well, that's it for me. If you liked this video, press the like button. If you have any questions, leave a comment below. If you don't want to miss out on future content, press the subscribe button. Thanks for tuning in, and I'll see everyone next week.